Hi class and welcome back. Today we're covering chapter 7 on capital assets and investments in marketable securities. So part of this plays off of what we covered last time in chapter 6. In chapter 6 we talked about capital project funds, which are the ways that governments set aside those particular monies that they're using for the acquisition or construction of capital assets for general governmental use. So we're going to talk a little bit more about what types of assets might be purchased or constructed in a capital projects fund. And so in this case, instead of speaking directly to the capital projects funds, now we're talking about what types of assets might constitute the capital assets of a government. We're also going to talk about some other assets that a government might have, for example, investments in marketable securities. Okay, so general capital assets. General capital assets. The main assets that a government is going to use, ones that are associated with the government as a whole rather than any specific fund. So for example, when we talk about general capital assets, we are not talking about any of those capital assets that might be used by a proprietary fund, by an enterprise fund, by an internal service fund. We're talking about the general capital assets that are going to be accounted for in the governmental funds. General capital assets are not financial in character. So at the end of this lesson, we are going to talk about marketable securities. Those are assets that are financial in character. They're separate from capital assets. Although they're both covered in this chapter, we kind of have a division, we have a split. So we talk about capital assets first that are, predominantly physical assets, although we will touch on intangible assets. And then separately, we'll talk about financial assets. General capital assets are, like I said, distinguished from other capital assets that are specifically associated with proprietary or fiduciary funds. We're talking about the general government here. Okay. So if we look at City of Houston's 2019, the description of capital assets. Now, the description that they provide is going to talk about the governmental funds and governmental activities. So capital assets are defined as assets with an initial cost of $5,000 or more and an estimated useful life in excess of 1 fiscal year. Now, the exact line for what defines a capital asset isn't clear. Each separate state and local government is going to define it. Generally, they'll define it in their CAFR somewhere for you, so that you can understand exactly where they draw that line. I mean, the general idea is it's something fairly valuable, so substantial amount of money, not necessarily a material amount of money, but a substantial amount of money, and that it has a useful life over a year. That'd be a pretty standard definition, right? So City of Houston has decided anything that costs more than $5,000 and is used for more than a year qualifies as a capital asset, okay? So as far as capital assets, the City of Houston's investment in capital assets and now they're talking about their governmental, and their business type activities combined together. The City of Houston's capital assets are worth $18 billion net of accumulated depreciation. And they give you some examples of what kind of things are included in those capital assets: land, buildings and improvements, machinery, equipment, storm drainage, streets, and bridges. The City of Houston's net investment in capital assets was relatively stable. There wasn't a big fluctuation from year over year. And we'll talk about what that means in terms of whether they're maintaining their assets or not later. Okay. So the largest portion of the City of Houston's net position is net investment in capital assets of approximately $5.9 billion, land, machinery, building, equipment, and infrastructures. Less any related debt used to acquire those assets. The City of Houston uses those capital assets to provide services to citizens therefore they're not available for future spending. Basically saying like this money is set aside, it's not convertible to cash, it's not convertible to current financial resources. These are assets for the city of Houston. So like we saw in the city of Houston's example, here are a couple of kind of fields that are, you know, types of general capital assets. Land is obviously incredibly common. Buildings, equipment, improvements to land and buildings, construction in progress. And then the next three we're going to talk about more: works of art, historical treasures, infrastructure, and then the last one is intangible asset. So you can see that all of these are physical, except for the last one, intangible assets. And the first 5 of these you've probably seen in your traditional corporate accounting classes. The ones that you might be less familiar with are works of art, historical treasures, and infrastructure. You'll see works of art and historical treasures also on not-for-profit statements. Today we're talking about state and local, but just as an FYI, works of art and historical treasures you will also see on not-for-profit statements. But infrastructure is one of those things that is uniquely governmental. There aren't a lot of companies that build bridges. That's something that's normally done by a state or local government, something that's done by a county or a city. So we will talk about infrastructure as a particular subset of capital assets as well. Okay, so how does the government get these assets? How do they acquire these capital assets? Obviously, some of the most typical ways are going to be purchase or construction. So for example, they might purchase a server system from a company like Cisco Systems. They might construct a building. They might have something contributed or donated. Somebody might donate a block of land or a historical artwork. They also might annex it. They might take out capital lease. It might be something that was acquired through foreclosure. And then there's 2 additional properties that I think bear some additional discussion: eminent domain and escheat, because those are very much just squarely in the domain of government and something you might not have seen before. So eminent domain, the government has a right to expropriate private property for public use with payment of compensation. Now, the most common example given for eminent domain is one that, you know, has happened a lot historically, is, for example, if they need to expand a highway and there is housing fairly close to the highway, they might purchase those houses through eminent domain. And what eminent domain means is the person can't decide not to sell the property. If you own private property and it is subject to eminent domain, it is no longer going to be your property. You do have, in most cases, you know, a right to some compensation. It may not be what you deem fair, but it's what the government has deemed fair for the property. Escheat is another one. Escheat is the reversion of property to the state on the owner's dying without legal heirs. So somebody who doesn't have a will, or who doesn't have a very obvious set of heirs, they don't have a spouse or children, if they can't find who the property of the deceased should belong to, then it will often go into escheat property, meaning that it just goes back and becomes property of the state. Okay, so those are 2. I mean, those are not, eminent domain and escheat are not the most common forms of acquisition for a government by any means. Generally, purchase and acquisition are going to be the most common. I just wanted to highlight those 2 because they are fairly unique to the governmental context. You're not going to have a corporation that owns escheat property or a corporation that can enforce eminent domain. Those are things that are specifically in the purview of the government. How are those acquisitions financed? In Chapter 6, we spent time talking about tax-supported bonds. We'll talk more about bonds and long-term obligations again in Chapter 8. We also mentioned things like grants from other governmental units, transfers from other funds, special assessment bonds. All of those are covered in Chapter 6. Also, you can have a capital lease. Just like a corporation can have a capital lease, a government, a state and local government can also have a capital lease. There's basically there's a variety of ways that capital assets can be acquired and a variety of ways that they can be financed. Okay. So how do you account for those general capital assets? On fund statements, because it's modified accrual basis, you're going to take the expenditure in full when the asset is acquired. So say that we use the server system, for example, City of Houston buys a server system. If they pay Cisco $15,000, then in the fund statements, it's going to be an expenditure of $15,000 in the year that they acquire that from Cisco. Even though for government-wide statements, that property is going to be capitalized and depreciated, in the fund statement, you take the full amount as an expenditure that year. In government-wide, because it's full accrual basis, it will be capitalized and depreciated. Okay, generally it's going to be capitalized and depreciated. Of course, like every good accounting rule, there are some exceptions. So you don't capitalize and depreciate inexhaustible assets. You've seen this in your for-profit accounting where land is not depreciated. Again, for governmental accounting, land is not depreciated. But now we have two other categories that are considered inexhaustible assets. You have art and historical treasures, and those are also not capitalized and depreciated. Okay, you're not going to take depreciation on a Van Gogh. Okay. If infrastructure is preserved in a specified condition, depreciation does not have to be taken. So we're going to talk about this in a minute when we talk about infrastructure, that there is an option available to state and local governments where they don't have to take depreciation, but we'll go into that in detail. Okay, so for how much should the value be? For purchased asset and constructed assets, by and large, this is going to look really similar to what you've seen for corporate accounting. So for example, if it's a purchased asset, then the capitalized cost should include purchase price, transportation, and installation costs. For land, it's going to include legal fees, title fees, appraisal fees, closing costs, and then the cost of demolishing any structures that can't be used. And then any other necessary or reasonable costs incurred to put an asset into use. Okay. For constructed assets, you're going to include direct labor and materials, overhead, architect fees, and insurance premiums. There's one big difference between the way you account for a constructed asset for state and local governments versus for-profit entities, and that is specified under GASB Statement Number 34. Governments should not capitalize interest on general capital assets they construct themselves. Okay? So in for-profit accounting, when you're constructing, for example, a building, you can include the capitalized interest costs. For governmental accounting, you do not capitalize interest costs. Okay? Other ways of valuation, depending on the way that the asset was obtained. If it was a trade-in, then you record it at the fair market value of the new asset. If it was donated, then you report it at the estimated acquisition value or replacement cost. Okay. All right. Collectibles. So those works of art and historical treasures. There's some interesting, when you're reading the chapter, I'm sure you'll run across this. The authors have a fairly facetious take of the opposition to valuing arts in government books. And they quote another source saying, "Only the most Philistine of accountants would even consider placing a $sign beside a priceless work of art." In their response, to report them as assets, it can be argued, would result in financial statements that are as surrealistic as art itself. So this gets into a fairly large debate about the value of art and how art value is determined. There are often, fairly notable auctions that occur. There's sales from museums to other museums or from private owners, private collectors to museums. But generally, the value of any particular piece of art is fairly debatable. Okay, and that's something that the authors are just kind of discussing there, is that, you know, how exactly do you value that piece of art? So when we're talking about that, if we look to the guidance, if we look to GASB number 34 does not require capitalization of artworks if they meet 3 conditions, and these are and conditions, not or conditions, so they must meet all 3. They are not required to capitalize artworks if it's held for public exhibition, education, or research in furtherance of public service. They are protected and preserved, and the proceeds from the sale of the collectibles are used to acquire other collectibles. So if, for example, the city sells a piece of art, they must use the money that they earned on that sale to buy more art. Okay? Arts and collectibles that do not meet these conditions must be capitalized. Now, the reason this is important is this is often why you end up having museum collections. There's a lot of different reasons that they rotate, but the accounting reason that they rotate is that then, you know, if they are rotating through their collection of art that they own, then at some point it is going to be held for public exhibition, and that will help them meet one of the 3 criteria they need to meet if they do not want to capitalize it. For capitalized art, revenue upon receipt of gifts should be recognized. Okay, so if it's not going to meet these conditions, if it's not going to be preserved, protected, held for public exhibition, and if the proceeds are not going to be used to purchase more art, then they need to recognize it as soon as they receive it. Okay. Infrastructure. So this is one of those other very particular types of capital assets. This one is completely unique to governments. Works of art and historical treasures may be held by corporations, infrequently, but might be, are likely to be held by some certain types of not-for-profits, for example, those in the arts. But infrastructure is something that just falls squarely within the realms of government. Infrastructure is a subcategory of capital assets. They're immovable, stationary in nature, and preserved for a longer period of time. We'll look at exactly how long. We'll look at an example of exactly how long the city of Houston anticipates a lot of its infrastructure will last. But some examples of the type of things that are considered infrastructure: roads, sidewalks, bridges, tunnels, highways, drainage systems, water and sewer systems, dams, and lighting systems. Those are some examples of infrastructure. Okay. GASB 34 requires that infrastructure be accounted for in the same manner as capital assets, except they need not take depreciation if they can demonstrate that they're being maintained or preserved at a specified condition or level. But in order to prove that they're, or document that they're maintaining or preserving at a specified condition or level, they must perform assessments at least every 3 years, have an up-to-date inventory of all the eligible assets, and estimate the amount required to maintain and preserve the eligible assets. Okay, so there's 2 approaches that governmental funds can take with respect to infrastructure. They can take the traditional approach, which is to capitalize and depreciate the asset, or they can take the modified approach, which is the secondary approach that requires a lot more documentation. It requires them to assess the assets, to keep an inventory of the assets, to estimate the costs associated with keeping the assets in the specified condition, okay? So how popular is that modified approach? Fairly unpopular among cities and local governments. About 30% of states are going to use the modified approach, but very few cities and local governments. Why? Just because it's fairly costly for them to go ahead and do that assessment of all of their assets at least every 3 years. Even if they keep that on a rotating schedule, they basically have to have several inspectors on staff that are able to go out and just do all the assessments of condition that they need to document it and to do the assessments of the cost. Okay. Deferred maintenance. So deferred maintenance, delayed repair or upkeep measured by the outlay required to restore a plant or individual asset up to their expected operating condition. How much do you need to spend to keep that asset in working, in not just working condition, but in a good specified condition? The disclosure of deferred maintenance is not required under GASB 34 unless they use that modified approach. Okay? If they choose to use the modified approach, if they don't depreciate, then they have to disclose actual versus necessary maintenance costs for a 5-year period. So, for example, if they're looking at a bridge and they say, okay, so to keep the bridge in the specified condition, we're going to need to spend $5 million, but they only spend $3 million on it that year, then they're going to have to report, under the modified approach, they're going to have to report both the actual costs of $3 million and the necessary costs of $5 million. Okay, so if the state and local governments choose the traditional approach, if they choose to capitalize and depreciate, they're not required to make all these assessments. Now, in my opinion, that creates kind of a big knowledge gap where we as citizens don't have a full set of information about how much it's actually going to cost to keep these infrastructure assets in good condition. If you capitalize and depreciate, you decide at the beginning of the life of that particular asset how long you think it's going to be good for. And say, assuming you've taken a road, for example, and you think that this road is going to be good for 15 years. And so when you set it up, you capitalize it and you depreciate over 15 years. Then what happens if during year 5 and a builder buys a giant plot at the end of that street and they develop a huge new suburb and the traffic on that road increases 3 times and now that useful life of that road has gone down? Well, you know, if you're using the modified approach, you would have somebody from that state and local government out there assessing the condition of the road and noting that there has been more damage than anticipated, and noting how much it's going to cost to actually preserve that asset and keep that road in good condition. But if the state and local government has chosen to capitalize and depreciate, they don't have that documentation of the wear and tear, and they don't have that estimation of the deferred maintenance costs. They don't have an estimate of how much they actually need to spend on that road to keep it in good condition. Okay, so let's look for City of Houston. City of Houston has decided to take its capital assets and depreciate them using the straight line method over the following estimated useful lives. Now, the reason I've highlighted some of those is because there's some of them that have a fairly wide range of estimated useful life, right? You can see there with streets from 6 to 50 years. Now, obviously, in part, that depends on basically the type of construction of the street and how much traffic they anticipate on that street. So whether they've built it out of concrete or whether they've poured asphalt, or you know, whether this is a 2-lane street or a 4-lane or a divided highway. Obviously, those things are going to impact the useful life. But there's a lot of flexibility here in terms of the estimated useful lives for different types of capital assets. Okay, so if we look at City of Houston here, we're looking at enterprise funds. Now, enterprise funds, like I note at the top of the slide here, by definition, are going to use traditional depreciation. So for example, the airport systems and facilities, IAH and Hobby, part of the Houston airport system, their depreciation is going to be based in the airport facilities. There's quite a range between 3 and 50, probably depending on what type of asset, you know, whether it's the tarmac or the building or a parking garage or whatever it may be. Okay. How does the City of Houston's infrastructure rate? Yeesh. Bridges, C-, drinking water, D, flood control and drainage, C-, rail, C+, roads and highways, D+, solid waste C, transit C minus, and we've got one good grade there, wastewater. There, we've got an A. But overall, the infrastructure in Houston is not in great condition. I'm sure depending on where you live, you might have definitely noticed the streets in your area may not be very good. Those roads and highways, that D+ grade kind of checks out based on my understanding of it. Flood control and drainage, C-. Obviously, things like Harvey have really shone a lot of light on issues with drainage and flood control, and the fact that we might be a little bit behind on our infrastructure investment in those particularly important types of infrastructure in the Houston area. Drinking water, D, that's not really a very high rating. So there's lots of things in Houston that we could probably be paying a little bit more attention to as far as how we are maintaining our infrastructure. And this is, I'll have the link for this one, but this is all from a third-party evaluator of engineers. Intangible assets. So all the ones we just talked about were all the physical assets of the government. Now it's important to mention intangible assets. Obviously, it's widely known that intangibles are generally not captured in book values. That's the whole reason that tech companies, their market value is often completely out of whack with their book value, is because most of their value isn't in any particular physical assets. Most of their value is in all the intangibles that they own. It's in that the software and then the value that they've created. So what does GASB say about that? GASB 51 mandates that intangible assets be recorded if they're separable and they arise from contractual of other legal rights. If they meet the conditions, they should be reported on the government-wide balance sheet and amortized over their useful life, but only in costs incurred during a specific period between technological feasibility and completion should be capitalized. Okay. So we do have GAAP for state and local governments. GASB has specified how to handle intangible assets in this particular arena. Okay. What about if assets are impaired? GASB standard number 42 is going to address that. Assets that have declined in their service utility significantly and unexpectedly are considered impaired. If impaired, a portion of the asset's historical cost representing the impairment must be written off. And there are 3 different ways to measure that impairment: restoration cost approach, service units approach, and deflated depreciation replacement cost approach. The textbook has done a really fantastic job of examples of these. So you really ought to just work through those in the textbook. The clearest way is just to, work through it as you go. Okay. Marketable securities. Okay, so now we've shifted. Before we were talking about non-financial assets, mainly physical assets, and then, a brief kind of the one slide on the intangible assets. Now we're shifting our focus. We're not talking about those capital assets anymore. Now we're talking about marketable securities. We're going to talk about all the financial assets that are held. Why might a government hold marketable securities? So, for example, one of the biggest reasons is that governments receive large amounts of cash. Those tax revenues that they collect on, for example, property taxes, they may not be spending it the following day. There might be a gap of, a week, 2 weeks, a month before that property tax revenue or sales tax revenue is spent. And in the meantime, they want to make sure that money is held in what we're going to assume for most cases is going to be a relatively low risk asset. Most state and local governments are required to hold a rainy day fund, something they need in case of emergencies. Oftentimes, resources in pension funds are going to be held in marketable securities. That makes sense. Same thing with permanent endowments. Those are often held in marketable securities. Exactly what permanent endowments hold, probably going to be specified when the endowment is established, what types of investments they might make. How do they hold them? So that depends in large part on how big of a government we're talking about. What kind of state and local government are we talking about? Are we talking about the city of Houston, or are we talking about a small school district? So if it's a larger state and local government, then they probably invest directly in marketable securities. If they're a smaller state and local government, for example, a school district, they might invest in a pool with other entities. So you might have all the school districts in a particular area that all participate in a pool, and they just invest in aggregate. What types of investments? Now, this is one where the answer is variable. Historically, traditionally, governments have invested in lower risk types of investments like bonds and treasury notes. So typically, governments invest largely in other governments. So cities, counties, other municipalities often would invest in things like U.S. Treasury notes. They would invest in basically, federal issuances. They might also hold the debt issuances of other municipalities. So they might hold the issuances of other counties or cities. They might also hold commercial paper. They might also hold big for-profit companies, bond issuances. Recently, and I say recently, but it's not even that recently, it's like 30 years recently, there's been a trend toward government participation in more complex securities, in derivatives. And basically, the long and the short of this one, you can definitely do your own research on this one, looking at, for example, Orange County in California. It's not always been a good idea for governments to participate in more complex securities. Okay? And obviously that's something that's, the subject of debate. You as a citizen, you as a constituent, you as a community member, might have an opinion about the way that the government is holding the money, and that's something that it's important to have your voice heard about whether you think that what they're doing is fiscally responsible or not, whether they're holding it in a type of asset that is likely to lose the city money potentially, in which case the constituents, the citizens, the taxpayers would be expected to make up that deficit. Okay, so let's take a look at what City of Houston has. So in the notes to the financial statement, they say the city maintains a cash and investment pool that is available for use by all funds. Okay, investment represents each fund's portion, blah, blah, blah. And then here is a summary of balances followed. So what exactly is in the pool? Like we'd expect, the largest proportion is held in U.S. Treasury securities. And in this case, this is, basically what the city is holding that's close to cash. So the WAM, the weighted average maturity in most of these is going to be under 1.5 years. So this is basically the way the city of Houston holds its, cash, or it's close to cash. The large portion in U.S. Treasury securities, other government agency securities, other municipal securities. We do have a money market fund there, some commercial paper. But yeah, the biggest thing is going to be basically other governments, debt issuances from other governments. Okay, so what does GASB number 31 say? Governments and not-for-profits per GASB, per FASB statement 124 must mark to market. Okay? So the debate about how to value marketable securities, I'm sure you've encountered that debate about in your other classes. So we're not going to talk about how to handle it for-profit accounting today. For governments and for not-for-profits, they must mark to market. So they're going to be taking that fair value. So gains and losses on investments, both realized and unrealized, must be recognized and reported in the statement of activities for all investments with a maturity greater than a year. Now, that phrase there, we're going to come back to that phrase again later. It's true for investments with a maturity of greater than a year. Okay. GASB number 72. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And again, you've seen those three levels in the hierarchy before. We're going to look at an example for City of Houston in a second. There is one area where guidance is missing. There's no guidance from GASB on when to report interest and dividends on investments. Okay. But if we look, so if we're looking at the City of Houston, their fair value measurements, we can see that the level 1, obviously U.S. Treasury securities, there's quoted prices. You can open up, Google Finance or whatever, browser you use, like whatever you use to check stock prices. You can check U.S. Treasury securities as well. There's a quoted market price for U.S. Treasury securities. For other ones, you can use other significant observable inputs. City of Houston doesn't have any level 3 securities. They do have a large number of those level 2 securities. So government agency securities, government mortgage-backed securities, municipal securities, and commercial paper. So any of you who remember anything about the 2008-2009 financial crisis, when you hear those words mortgage-backed securities, you might kind of pull back. The good thing is, if you look here, you can see that although it's not insignificant, the City of Houston holds only 5.91 million out of 1.759 billion in those mortgage-backed securities. Okay, so it's not a large portion of the City of Houston's portfolio there. Okay. So what are some of the concerns here with using mark-to-market? What about the real effects of disclosure? So one of the things that economists are generally concerned with is the behavioral implications for rules. So people do respond differently depending on the way things are framed and the rules that they've been given to kind of abide by in whatever game. And now obviously this is not a game, but from a behavioral perspective, it's considered a game. So for example, people react differently depending on whether something is perceived as a gain or a loss. Now here, the issue is that managers have an incentive to choose things with if they're considering something with a 2-year maturity or something with a 1-year maturity, they're going to probably consider the one with the maturity of a year or less more strongly, because they don't have to do the mark-to-market, although they might be leaving money on the table. So they might be better off. They might get a higher interest rate on that 2-year security instead of that 1-year security, but they might be disinclined to take it just because of the potential consequences of mark-to-market. So what are the consequences of mark-to-market? So whenever you have to mark-to-market, that fair value is what's going to appear, and you have to remember, you have to recognize realized and unrealized gains or losses. And those unrealized gains or losses, those paper gains and paper losses, are going to be reported to City Council, to the citizens, and you're a fairly well-educated community member because you're in a master's program and you have a fairly good understanding of accounting, but not everybody has that same level of understanding, right? And so some of them might assume that those paper gains or paper losses are money that either can be spent or money that is actually gone. Okay, so those paper gains in particular can be problematic because the city might think, well, they have more money to spend than they actually do, because those paper gains don't actually count. They aren't actually spendable. They aren't actually, current financial resources that can be used until they're realized. Okay, so for example, in 2019, there might have been substantial paper gains that were wiped out early in 2020 and might be reclaimed at this point, or might not be. It very much depends. But if the management or the citizenry were under the impression that that gain was a real gain instead of an unrealized paper gain, they're operating from a different set of, a different framework for their budgeting. The other concern is that governments have been increasingly participating in more complex securities, right? And that one has its own set of issues that we're going to set aside for now and discuss later. Okay, one of those types of more complex security is a derivative. Now, I'm sure a lot of you are familiar with derivatives from some of your other classes. You can have derivatives on many different things. You can have derivatives on commodities. You can have derivatives on interest rates. They're financial instruments that are relative to the pricing of a particular thing. Okay, so GASB statement number 53, accounting and financial reporting for derivative instruments. Derivatives should be reported at their fair values. Remember, for governments, we're doing mark-to-market, so their derivatives are going to be reported at fair values. So those changes in fair value are going to be reported as gains or losses on both fund and government-wide statements of changes in net position. The only exception to this is, like a good accounting rule, there's an exception. Derivative instruments that represent effective hedges against other assets or liabilities should be deferred and reported on balance sheets as deferred inflows or outflows. So, for example, if a city had engaged in an interest rate swap on some outstanding bonds and that derivative provided an effective hedge, in that case, instead of recognizing those gains or losses that year, they would be deferred and reported on the balance sheet as deferred inflows or outflows. With all derivatives, there are extensive disclosures required in the CAFRs. They have to describe the nature of the derivative, the reasons why they entered them, all types of different risks must be disclosed, and they have to disclose any significant terms for that derivative. Here are some examples of the risk disclosure requirements required under GASB number 40. They should organize disclosures by investment type, and then they have to disclose their types of risks for each of them. For custodial risk, as the name custodial implies, it is if that particular security is uninsured, uncollateralized, not in the name of the government itself, or not in the physical possession of the government. Or if there's some reason that derivative may not be held by the government and may not be, easily traceable to the government. Credit risk is your risk associated with the counterparty, so the other party in that derivative transaction. The credit risk is the risk that they won't fulfill that obligation. Okay. Interest rate risk, obviously interest rates can change, so how changes in interest rates will affect the fair value of the instrument. And then foreign currency risk, that one's less common, but depending on exactly what type of derivatives are held, that might be a concern for some of them. So for example, this is just one example of a risk disclosure. This is not all of the risk disclosures. There's multiple risk disclosures for each type. And so for example, this one's just saying, for the interest rate risk, in order to ensure the ability of the city to meet obligations and to minimize potential fair value losses arising from rising interest rates, the city's investment pool policy limits its pool of dollar-weighted average maturity to 1.5 years. This is the one related to what we looked at before, where that weighted average maturity was, I think, 1.3 or something. It was under 1.5. As of June 30th, 2019, the pool's dollar-weighted average maturity was 400 days. Okay. The city's investment policy limits investments in the tax-exempt pool to high-quality securities, with a maturity of less than 3 years and a minimum rating of AA. So that's going to be where they're going to be relying on those third-party rating agencies to determine which types of investment are considered high-quality investments. Presumably with a high-quality investment, you have lower credit risk. custodial credit risk. None of them were subject to custodial risk. So basically, City of Houston had possession of the contracts for all of these, and they were named. And in this particular, all of them were denominated in the US dollar, so they didn't have any foreign currency risk. Okay, they don't have any risk of the US dollar being devalued against another currency, because all of these were US based securities. It was US Treasury bonds and other US municipal securities. There was no foreign currency risk associated with this particular pool. All right, okay, so that wraps up chapter 7, capital assets and investments in marketable securities, two completely different types of assets, physical assets and then financial assets, or physical assets plus intangibles, and then financial assets. And then we will be back again next time for chapter 8, where we talk about long-term obligations, and that'll kind of wrap up that little section of chapters 6, 7, and 8. All right. Have a good one.